A woman in Portland did everything right, paid off her mortgage, maxed out her 401,000, planned her retirement for 4 years with a spreadsheet and a financial advisor. Then she logged into the health insurance marketplace and saw one number, $890 a month, just for her, just for healthcare, until Medicare kicks in 5 years later. That is $35,000 she never planned for, and there is a specific reason nobody warned her and a specific way to fix it.
You know, the single most consistently underestimated expense in American retirement planning isn't travel, and it's not property taxes. It is the healthcare cost gap between early retirement and Medicare. In this explainer, we're going to expose this massive financial blind spot. We'll walk through the exact numbers and, more importantly, the actionable strategies you need to survive it. Okay, let's dive right into this. I want you to picture a very specific Monday morning. It's January 2026, in a home office inside a Craftsman bungalow in Portland, Oregon. Sitting at the desk is Diane. She's 62 years old, and she actually just retired 8 months ago after 27 years as a senior marketing director. And she planned this retirement for 4 years. I mean, she had the spreadsheet, she had a financial advisor, she did everything right. She paid off her mortgage at 59, she maxed out her 401k contributions for her last 6 working years, which brought her balance to $487,000, alongside a taxable brokerage account sitting with $94,000 in index funds, 0 debt. But as meticulously as Diane modeled her property taxes, her travel budget, and her investment withdrawals, she missed one absolutely critical variable. She just assumed healthcare would be manageable, right? Just like it had been for 27 years when her employer partially subsidized it. But in June of 2025, after her employer coverage ended, she logged into the ACA marketplace for Oregon. Now, Diane's retirement budget had conservatively allocated $300 a month for healthcare. What she found staring back at her on the screen was an actual net premium, after subsidies, of a staggering $890 per month. For one person. And that came with a $4,200 deductible she'd need to meet before most coverage even kicked in. Let's just look at the harsh math on that. That is a $590 monthly deficit. Over the 5 years, from age 62 to 67, when her Medicare actually begins, that unmodeled gap represents a massive, unexpected expense. We are talking about $35,400 just in sheer premium deficit that is going to actively drain her retirement accounts way faster than she ever modeled. This right here is the uncompromising reality of the Medicare gap. You see, Medicare eligibility in the United States begins at age 65, without exception for most Americans. It literally does not matter when you retire or how long you worked. If you retire at 61, you are entirely responsible for sourcing your own health insurance from the private market until age 65. Every single month of those intervening years falls squarely on your shoulders. And this brilliantly illustrates exactly why early retirees get caught so off guard. Let's look at the actual unsubsidized costs for a 62-year-old on the ACA marketplace in 2026. In a lower-cost market, a benchmark silver plan is roughly $980 a month. The national average, that sits around $1,180 a month. But in higher-cost markets, like California, New York, or Diane's home in the Pacific Northwest, that premium skyrockets to $1,480 a month. Before any subsidies, this is your sheer baseline cost of entry. So the absolutely crucial point here is understanding how to get financial help with those staggering numbers. The linchpin of early retirement healthcare is your MAGI. That stands for Modified Adjusted Gross Income. This one specific figure strictly dictates whether you get a subsidy to soften the blow or whether you're forced to pay that full punishing market rate. To see exactly how MAGI works as a lever, let's walk through the subsidy math. If a 62-year-old structures their retirement income to show a MAGI of roughly $35,000 a year, their net premium shrinks to a very manageable $300 to $500 a month. Pretty good. At $60,000 in MAGI, well, that premium jumps to between $700 and $950. And if your MAGI crosses the $80,000 threshold, the subsidy practically vanishes entirely, leaving you holding the bag for the full $980 to $1,480 monthly premium. And this is the exact trap Diane fell into. Her unmanaged 2025 retirement income was drawn heavily from traditional 401k withdrawals, some brokerage dividends, and a small consulting project. Together, this pushed her MAGI to $72,000. At $72,000, her subsidy was severely limited, landing her right at that painful $890 monthly premium. She essentially let her income dictate her premium, rather than proactively managing her income to protect her premium. But an $890 premium isn't a life sentence. It's just the unmanaged outcome. Let's explore the 4 specific, actionable strategies that can rescue early retirees from this trap. We've got income management, the spouse bridge, the COBRA bridge, and the HSA reserve. Strategy 1, and honestly the most potent tool in the box, is income management. Remember, withdrawals from a traditional 401k count as ordinary income. They increase your Magi directly, which destroys your ACA subsidy. Conversely, withdrawals from a Roth IRA do not count as income at all. And drawing from a taxable brokerage account primarily represents a return of your own capital, meaning only the gains are taxed. That keeps your Magi artificially low while you still fully fund your lifestyle. If Diane had been advised to shift her withdrawal strategy, say leaving the traditional 401k alone for now, and instead funding her living expenses through her taxable brokerage account and some small strategic Roth conversions, she could have intentionally targeted a Magi of roughly $38,000 instead of accidentally hitting $72,000. The immediate financial impact of that one strategic shift is massive. At a $38,000 Magi, her monthly ACA premium plunges from $890 down to just $340. That single decision to manage where her cash comes from saves her $550 every single month. Over her 5-year gap period, that is a total savings of $33,000. And she didn't reduce her actual standard of living by a single penny. Strategy 2 is the spouse bridge. So Diane's husband, Paul, is 64. He's still working as a consultant and has his own employer health plan. He has exactly 11 months until his own Medicare kicks in. For those 11 months, Diane has the option to join Paul's employer plan as a dependent spouse. Because the employer heavily subsidizes the premium, this offers a deeply discounted window, allowing Diane to delay entering that expensive ACA marketplace for nearly a full year. Then there's strategy 3, the COBRA bridge. For the very first year of retirement, utilizing COBRA can be a brilliant move. The ACA marketplace is genuinely dangerous in year 1 of retirement because the subsidy requires you to estimate your income for the year. If severance pay, consulting fees, or asset sales push your income higher than you guessed, the IRS is going to claw back your subsidy at tax time. COBRA, on the other hand, comes with a higher fixed cost, but it carries absolutely zero income estimation risk. Yes, Diane's COBRA premium from her former employer would be a steep $1,240 a month. I know, it sounds counterintuitive to pay more, right? But for an early retiree dealing with chaotic, unpredictable transitional income in their very first year out of the workforce, locking in a fixed premium of $1,240 to completely avoid a massive tax time subsidy clawback, that is a highly sophisticated risk management play. Finally, strategy 4, the pre-retirement HSA reserve. If you're enrolled in a high-deductible health plan, the IRS allows workers aged 55 and older to contribute up to $5,300 annually to a health savings account. This money is fully tax-deductible, it grows tax-free, and it can be withdrawn tax-free for medical expenses. The ultimate triple tax advantage. If a worker simply maximizes this HSA catch-up contribution for just the 3 years prior to their early retirement date, they automatically create a $15,900 tax-free war chest. This fund exists strictly to cover gap year premiums and out-of-pocket healthcare costs. And because it's tax-free, using it to pay for healthcare is completely invisible to the Magi calculation, perfectly protecting your ACA subsidy. So let's bring this all together and look at the climax of this analysis by comparing Diane's 2 potential financial futures side by side. Both scenarios use the exact same retirement assets. Both scenarios maintain the exact same standard of living. The only difference is whether the healthcare gap is left completely unmanaged or proactively structured using the tools we just covered. The unmanaged reality, it is brutal. Retiring at 61 with an unoptimized $72,000 Magi, 0 HSA reserves, and paying $890 a month plus deductibles over 5 years, that drains a staggering $78,000 from Diane's portfolio. That is $78,000 of hard-earned wealth just evaporating, simply because the withdrawal structure wasn't optimized for the tax code. But look at the managed reality. By simply shifting withdrawals to a taxable brokerage to cap her Magi at $38,000, utilizing Paul's 11-month employer bridge, and drawing on a pre-funded HSA reserve, the total cost for the exact same 5-year gap plummets to just $39,000. Pure financial strategy and knowledge literally cut the Medicare gap expense precisely in half. So, if early retirement is on your radar, here is your stark 3-point checklist to execute before your employer coverage ends. Number 1, go to the ACA Marketplace calculator and run your estimated net premium based on your projected Magi, not your gross income. Number 2, maximize your HSA contributions immediately if you're within 5 years of retirement. And number 3, exhaustively analyze your spouse's dependent coverage options to delay your ACA entry. You have to run your own real numbers immediately. Which brings us right back to Diane, sitting in her home office in Portland. She actually has a call with her financial advisor scheduled for Thursday. And instead of just accepting that $890 premium on her screen, she now knows the ultimate key to surviving the Medicare gap. The single most important question you must ask before you retire is this: how do I structure my income this year to maximize the subsidy? Because right now, every dollar of unmanaged income could be quietly draining your wealth. What is your magi going to be, and how much is it going to cost you?
So that is the Medicare gap, the single most underestimated expense in early retirement, and the one almost nobody puts on their retirement checklist until the browser tab is already open and the number is already real. For Diane, the difference between managing it and not managing it was $39,000 from the exact same retirement savings, the exact same health, the exact same lifestyle. Here is what matters. If you are planning to retire before 65 or you already have, this number is coming for you whether you plan for it or not. The only question is whether you see it before you retire or 8 months after. Hit subscribe right now and turn on notifications, because every week I break down another real retirement scenario just like this one. The exact numbers, the exact mistake, and the exact fix, in plain English nobody else gives you. And if you are already retired or planning to retire before 65, go watch the video right on your screen next, where I walk through exactly how to manage your income to maximize your ACA subsidy step by step. Drop your situation in the comments, your age, your state, your planned retirement age, and whether you have actually run the ACA Marketplace calculator with your real numbers yet. I read every single one. I will see you in the next one.